If you can hear us, try clicking the video start again. There you go.
There you go.
I'm
Hello.
here. Hello, everybody. Hi,
How's
Sid.
it
Hi,
going?
John. Good afternoon to all.
Guys,
Good afternoon. We are going to start. Hello, everyone. Thank you for joining us at DataCon LA 2020. We are starting session with Sid Mohasseb, John Harbison, and Nader Fathi. We are going to talk about, they're going to talk about money and opportunities for data analysis startups post-COVID. My name is Hestia, and my co-host is Dimas. There are a few things that I'd like to talk about before we start. All participants are muted to avoid distractions during sessions. Please use the chat app with your mobile app on mobile device or desktop. If you have any comments or any questions during the session, next to the chat is the session Q&A, which will be dedicated section for questions. We will be monitoring it and help you ensure that they are delivered to the speakers to be addressed. Please note that the Zoom Q&A won't be monitored as well, so please use the WOVA app. The WOVA app is also here to provide you the ability to create discussion topic on the community section that will be viewable to all DataCon LA attendees on the WOVA platform. So without further ado, please welcome, and you guys can start. Thank you so much.
thank you. Thank you. Well, welcome everybody. This is an unusual situation for the three of us to not be in front of people and have this conversation live. So we'll try to make it as lively, despite the fact that it can't be too interactive given the platforms and situations. I'm hoping that we would keep this conversation rather short, as opposed to the hour and a half. We'll probably end it sooner and leave as much time as everybody might need to focus on questions that our thoughts and conversation may lead to. So let me start with introducing the panels. Actually, I'm going to ask John and Nader, who are two veteran both entrepreneurs, and John is a veteran investor as well, and they've been in this game for a long time and have seen lots of cycles and lots of situations and lots of companies, and they have quite a few scars in the battlefield to share with us. So let's start with John. John, if you could give us a few minutes of your background, and then we'll go to Nader.
Sure. Thank you, Sid. And it's a pleasure to be part of this panel, and we look forward to your questions and hopefully all coming away learning a little bit from each other. After about 20 years in management consulting with one of the big firms, in 2001, I switched over to the startup world and spent the last 20 years in the startup world. Initially, I started and led a group at Raytheon, the defense company, that reported to the CEO and launched 5 companies in a couple of years. 2 of those we got to liquidity events. These were defense technologies in commercial markets, and they doubled their money in those 2 liquidity events. And a third of the 5 ended up growing to about $700 or $800 million of sales in 7 years. It's automotive. It was the first automotive blind spot detection radar. So if you're driving your car and your car is beeping or flashing or vibrating your steering wheel, you have me to blame for that. I did a stint as a CEO of a network security software company. After that, called Silent Runner, and that we sold that to Computer Associates, which is the place where great companies go to die. Over 60 startup investments later, I joined Tech Coast Angels in 2003, and I serve on multiple boards and also serve on the board of Angel Capital Association. I've served as chairman of TCA, which is one of the largest angel groups in the country. We currently have a little over 450 members, over 450 companies that we funded since 1997 when we got started. We've had about 180 outcomes out of that. If you'd invested in all those 180 that have had outcomes, that's both the exits and the write-offs, you'd have a 4.8x return and 23% IRR. Overall, we've invested about $250,000. And in the last year, we invested $19 million. I looked at that, it's across all industries, but of those 450, 96 of them were in the software category. And if you'd invested in all of our software companies that have had outcomes, you'd have a 10.3 times multiple. So actually, we've done better in the software category than we have in some of the other verticals. We had one big home run in that area, which as an angel investing and venture capital investing tends to drive your returns. And that was a company called MindBody, which did software for the fitness vertical. And if you'd invested in that, you would have gotten a 260 times return. So that's a little bit about my background.
Thanks, John. Nader, you want to let us know a little bit about yourself and the multiple companies you've
Sure. Thank you, Sid, and thank you, DataCon LA, for inviting me to this exciting panel. My name is Nader Fathi. I did my undergraduate and graduate work at USC, and then I worked for some big companies. I started my career at Xerox in El Segundo in Microelectronics Center. Then I moved to the Bay Area. I worked for Cadence when we were 50 million, and when I left, the company was 1.2 billion. That was a nice run. And then I worked for another company, Ecosystem, that eventually we sold successfully to Mentor Graphics. So in 2000, I started my first company called SigmaQuest. SigmaQuest was a big data company. We provide real-time visibility to factory floors in China and Mexico. Our customers were big electronic manufacturers such as Apple, Honeywell, BlackBerry, Nokia, you name it. That company was successfully first bought by Camstar and eventually by Siemens. So it was exciting. I am a serial entrepreneur. So since then, I started a second company called Kiana Analytics, as well as I have been an executive in resident at USC Stevens Center, as well as Plug and Play Tech Center, as well as Alley by Verizon. So I had the opportunity not only to work as an entrepreneur focusing on big data and data analytics, but also working and coaching over probably 100 companies worldwide. I have coached companies from Korea, Taiwan, Turkey, Jordan, and of course, US, that companies which are working on data analytics all the way from retail to sports analytics to big data and so on and so forth. So it's great to be here in this exciting panel. Thank you, Sid.
Thanks, and welcome to both of you. As you can see, we have serious expertise here. I briefly, my background is I graduated too from USC and with an operations research degree, which was, I guess, data science before data science had a name or it was cool. I remember my father said, "What is this thing that you're getting?" And I was ill-prepared to explain it. About 30 years later, I said, "Hey, it's becoming cool now. It's okay." So I have had the privilege of being part of Tech Coast Angels with John, and we've invested and sat on boards together. And with, in full disclosure, I'm also an advisor to Nader's company and Kiana. I have started 5 companies. 4 have done well, and 1 did not during the dot-com era. Multiple of them have been venture capital backed. I have also acquired a number of companies in basically turnaround space, in aerospace, in non-destructive testing and manufacturing, in electronic distribution, and in media. But in every case, I've had some sort of a play that has been strategically important to the company, using data. So I have been a data guy, but mostly on the how do you use it strategically to get advantages. And my last company, which was invested through my fund, Venture Farm, was a company called Wise Window, and it was sold to KPMG, and it has become the seed for essentially the core group that is now KPMG Lighthouse, and I believe they have about 1,200 or 1,500 people now. And I am now basically teaching at USC, data analytics consulting in the engineering department, and data-driven strategy, dynamic strategy and execution at Marshall Business School. So with that, let's get started, Nader, with you. Let's talk about opportunities around data analytics in general. How do you see the opportunities ahead for startups in data analytics space? What do you see? What's going on?
So first of all, what is happening, Sid, is that we live in an era where almost processing power, memory, and also channel is almost for free, right? And this is really important. When I started my first company in 2000, that was not the case. We had to go and buy our own servers. We had to host it in our office and so on and so forth. Today, anybody can get on Google Cloud or Amazon or Azure and start building the company. So I think it has come much easier. So that's number one. The second one is that we as a society generate lots and lots of data. So there's a lot of data out there, which is basically, believe it or not, is what's running our day-to-day life, right? So I was just thinking about Amazon driving from actually Bay Area to Los Angeles this weekend where I am. And I was thinking about what Amazon is really doing. And if you look at it, really the power of data, it's what's running a company such as Amazon. So think about it. They have data which really helps them with customer engagement, right? They have data which is really helping with personalization, right? So they know that I like business books, so I get reminder from them about the latest book which came out and so on. This really helps them with their price and production. And last but not least is really you're going to see more and more personalization. So to answer your question, Sid, I think there's a lot of data out there. And I want to actually talk about the personal experience here. So when we sold SigmaQuest, my last company, when it was bought by Siemens, and I went back as an executive in resident, a big Wi-Fi company called us, and they said, we have a lot of dark data. Can you guys help us? And I never really heard the term dark data. I know about dark data is what's dark data. And they told us again at that time, the data that they collect from the Wi-Fi devices and so on, and that really give us a light bulb. So to answer your question, I think there's a lot of data out there. The challenge for startups is to really identify how do you monetize that? And I think that's really the purpose of this panel here, because the data is there. The question is that who owns the data? What can you do with it? And at the end of the day, how do you convert it into dollars and cents?
That's good. So as you said, there's lots of sources of data. I think what's interesting is that you could categorize companies, and I think because of COVID particularly, there has been a massive acceleration in what I call resistance lines being broken. So we've got, I believe we're at about 2028 with respect of the estimates of how the penetration of retail usage or mobile payment would be in a 3 month, in a 2-3 month time frame post-COVID, because people started using things out of necessity, and yes, some would go back, but a lot would not. The idea of people working from home pushed a lot of companies to take things to cloud much faster than they expected. So this resistance lines that people were, oh, you can't work from home, too many issues. Oh, I don't like to buy things from Amazon, I don't trust that. Well, when we have to eat, we'll figure out a way to click on the button and get something to eat. So people figured all this stuff out. The banking situation is another interesting one that, a lot of people, particularly the older generation, were very focused, and I am part of that older generation, to go to the bank and make a deposit. Well, that's gone away. And the value of money is, you know, it's kind of like, I remember I teach in China and every summer. And I remember I went to China once a couple of years ago, and we were stuck at a bridge, and they wanted like 10 yuan, which is like less than $1 or about $1. And nobody had any cash. You know, we went to all the way across, there was a line and we couldn't cross, and nobody had any cash. Because that environment and that culture works now a lot without the cash. And that's what's happening here now. But you've got companies that are involved in using the data, which is the data monetization. We could talk about that as a separate, I think, path. Then you have companies that are in the infrastructure business, which is how do I get more storage, more processing, faster, dual things, and because you have to process all of this data that's being generated. And then you have companies that are in the tool business, that you take this data and do something with it. You put it on a dashboard, you do something, you know, and the spectrum is from you know, Tableaus of the world to people who have a company like yours that's using the data in order to transform and use it for a different purpose. But it's a platform play. Now, in all of those three buckets, there are opportunities. And perhaps as we get later in the session, we can talk about the execution differences, because they're entirely different animals. And they require entirely different approaches and entirely different mindsets to get to them. But John, before we go to the overall investment dynamics, do you see any fundamental difference between you know, the speed that we talked about in the data analytics space and companies and startups? Because there's lots of them coming.
Yeah. Well,
And everybody else?
I think there's a lot to like in this particular general area. I guess from an investor perspective, I like that the outcomes when you do develop something that's really powerful can be very large with a lot of zeros after end of it. That's not true of some verticals such as consumer products and consumer internet. Second is I like that very often there is some technology edge, proprietary edge, although in the software area, it's all, you know, it's hard to get patents in there, but there is an edge there. So there's some barriers to entry. I like that software businesses tend to be very scalable. The cost of sales is negligible and no inventory costs and working capital costs. I like that the market is, I think, at an inflection point for the things that Nader just mentioned, with the opening up of a lot of new opportunities from those technology advances. So there are a lot of unaddressed problems out there and needs that need to be met, and compelling value propositions. I like that it's not capital intensive in terms of CapEx. As Nader said, you don't, it's not quite free, but it's a lot less than it used to be. And again, you know, working capital. The things I don't like as much in this area, or I'm cautious when I do investments, is one is there's always emerging competition and always better solutions coming out. So even if you have an edge today, you know, it's hard to sustain that unless you're constantly innovating. So I'm looking for companies that are never satisfied with what they have and are moving forward. And then you know, sometimes I don't like the hype leads to valuations that's too high. But just to summarize that, I think the key to this area and opportunities is to turn the proprietary edge or technology out from GWiz technology into real solutions that are specific and a customer can grasp it. And just to give you an example of that, the company I alluded to called Silent Runner, our technology came from work that was done for the NSA. And this was in the network security space. And basically our technology could plug one of these devices anywhere into a network, and it would look at 100% of all the traffic going on, not just from the outside inside, but also inside to inside. And then it had a 3D visualization where you could basically fly through your whole network, see all the nodes talking to everyone else. It was, you know, very much no privacy, but as you saw everything. And it did 7 layers all the way from the top level of software down to the ones and zeros in each individual document. So it's very powerful and very versatile. And when we would present this to a CTO of a commercial company we're pitching, the reaction was usually, wow, this is really great. I love this technology. But the CTOs didn't have any money. The money was all controlled by the CIOs. And the CIOs basically need to keep the computers working, the printers working, and not have any great, bad things happen. But they were high on their list wasn't, maintaining the security of it. So, and this was 2003 when their budgets were getting crunched because of the recession that we were all in at that point in time. So it was very hard to sell product that was $150,000 a seat when the only one who had money didn't want to spend any money in this area. So we didn't have time to develop a new product. So we took the same product and it was essentially a 100-blade Swiss Army knife, which is very complicated to explain. And we took one blade out, duct taped all the other ones in there, and we went to each vertical with a different vertical solution. So we go to a bank and we'd have the duct tape. He says, this is an insider trader detection tool, or this is a credit card fraud detection tool. We go to a power plant. We say, this is a SCADA compliance that keeps the terrorists out of your network. We go to each vertical with a different solution. And it was the same piece of software. We changed the color on the label and that sort of things. And if they wanted to do it for something else, they could take the other blades out, but it came as a solution. So that was one thing that we changed the solution. And then the other part was, it just didn't make sense because, VARs weren't working because they didn't want to work hard enough to explain all this stuff. And we certainly weren't big enough to have a big, direct sales force, and certainly wasn't going to sell on the internet. So we had to cut a break to that. So we said, so the CIO has the money. So that's my customer. How do I solve his problem? So we went to him and said, you're spending $15 million or so on intrusion detection systems and firewalls to keep your place safe. Rather than have all those doors and windows locked, this looks at everyone going around inside your house for a lot less. So you spend $2 or $3 million on us, you can spend at least $5 million or $10 million less on the IDSs. And this is a way for you to save money. And suddenly we were selling $2 million systems instead of $200,000 systems. So any of these businesses, it's very clear that you gotta be focused on a solution and who has money and how you're solving that individual's problem. And then ultimately you can have a sustainable company.
That's
Sid,
such.
I'm sorry,
Sure,
so can I add some more to this? So first of all, I totally agree with what John is saying, fall in love with a problem than a solution, right? This is kind of obvious, but unfortunately we as engineers and data analytics sometimes forget about this. Just the fact that you can build a solution and you're trying to go out there and finding a problem is the wrong way of doing it. So, and I give you a great example. I was at the panel with the president of Zoom, and he was talking about how he started the company and so on. And he worked on, before announcing Zoom, like 3 years, going and really getting data of what are the problems. What is it? If you recall, he was also at WebEx, right? So what were the problems with the existing web conference? So I think it's really important to identify what is the pain point and what's the problem, right? But what I used to call it the aspirin and vitamin. I call it now the vaccine and vitamin, right? What's the vaccine people are looking for? So that's number one. The second thing that John talked about, and is very important, is that do not mix B2B, which is business to business, versus B2C. The data that you are collecting from consumer is very different than the big company is collecting from his own operation and what they can do with it. And I think that's, so one of the red flags is when I hear entrepreneurs saying, hey, you know what, the company I have is B2B to C. And I said, no, you either do one or do the other one, right? You cannot mix apples and oranges in this case here, right? So I think those 2 points, fall in love with really a problem versus a solution. And then the second one, really define who are you going to sell this to and what are you going to do with this data? That's really the key here I wanted to highlight.
Excellent. So John, before we go, I want you to talk about the investment dynamics, and we could talk a little bit about that. But one thing that your conversation and Nader's remark pointed out is this pet peeve of mine recently about this minimum viable product. And what I have seen is that people focus on the minimum as opposed to the viable. It's, well, we could get something out there, but nobody wants it. Well, but we can do it. Well, it doesn't matter what we can do. It's a matter of exchange. The exchange is, entrepreneurship is a matter of exchange. You have something, you take a risk to provide it to somebody who would want that something, and they pay you for it in return. So that exchange, if it's not there, there is no business. The business happens when there is an absolute value that somebody needs, and you are delivering this value to them. So this idea of minimum viable product, it's just, you know, I hear a lot of entrepreneurs say, oh, we're working on a minimum viable product. And when you drill down, it's like viable for them. And it's the minimum.
Yeah.
So
Well, I think part of the problem is somebody started with an acronym and then came up with, so they thought MVP was a cool word, because we all had a different, positive connotation associated with it.
yeah. The other one is this fail fast, fail often business. And nobody wants to fail fast. It's stupid to fail fast.
But I think there's certainly a germ to wisdom in both of them.
Correct, there is.
Certainly lots of companies. You and I were on a board of one that wanted to create this grand thing. And we kept saying, no, just get something out the door. And he kept wanting to make the interface perfect and all this. And so the part of it is, the minimum part is.
A lot of my white hair, by the way, is from that deal.
And it was a great idea. And it could have been with different leadership of somebody doing that. I think we'd still be here today and it would be a very big company. But so part of it is, there's wisdom in it, is you don't want to just keep developing without getting feedback from customers. So you need feedback from customers. But in the first iteration that you need come out there, let's say there are 10 things that you want to do for that customer. They have varying levels of a value proposition to them. The part of it is, don't try to do all 10 up front, but pick one that's probably going to have the biggest benefit, certainly the best ratio of benefit and cost. And do that, and then have those other things following up later. And that's really what the MVPs are all about.
Correct. And it's not the biggest benefit, John, it's not the biggest benefit from the entrepreneur's point of view. It's the biggest benefit from the person who's paying for it, because sometimes, oh, this should be a very big deal. But hey, they just want this. This is what they want. So
you mentioned fail fast as an example. It's important, if you're going to fail quickly, so you can still have some money and gas in the tank to go do something else. When you do that and you don't need more money, people don't want to give you more money, so you want the feedback and know soon. And one of our two largest successes at Tech Coast Angels, one that you're very aware of, Sid, was a company called Green Dot.
Yes.
And they were in the financial services space. And this was a company that Tech Coast Angels originally invested back in 2002. And the entrepreneur came to us with an idea that he was going to create prepaid debit cards for rich teenagers. And he managed to convince a lot of TCA members to invest in this. We put over $1.5 million into it, which is, in the top 5% of the range of what we put into individual deals. And in 6 months, he developed the whole product. In 6 months, he failed. And he failed because he quickly came to the realization that rich teenagers didn't need this solution, because they just went and used mom's credit card. It was already solved. But he had this whole thing set up, and he says, but there's this whole big underbanked people out there who don't have a bank account, don't have a credit card, and they're not all teenagers, they're older people. And they want the convenience of using this debit card. And so he pivoted the company with the same product. It's sort of like what I described at Silent Runner. He didn't really change the product. He just pivoted to a different set of customers, and then executed really well on that strategy, and ended up becoming a public company, and then growing as a public company. We had a 235x return. But it's so if you do that when there's still time left, that's good. It's good it didn't take him 3 years to figure that out, or he probably wouldn't have gotten another round of money from us or anybody else. So there's wisdom in these things, but sometimes the condensation into words, make you think the wrong things about them. So I'm glad you asked for a clarification on those.
So I've turned that. It's okay okay to learn fast, but it's not okay to just fail after fail after fail. Because one time an entrepreneur came to me, and I was on a board, and says, well, you know, we've identified 6 failures. You know, Edison did 10,000 before he came to him. I said, that's not the point. The wrong metrics of doing something doesn't necessarily mean that you're doing a good thing. What did you learn from them?
Yeah, it's absolutely important to learn from mistakes, and it should be your collective mistakes, not your individual mistakes. Every team that I've ever led, I give them a speech up front saying, I want you to take risks. I want you to press the envelope. And it's okay to make mistakes, but you need to be able to learn from them and articulate them and teach your cohort the mistakes so that we have collective learning. And so, like when I was at Raytheon, we had the whole pipeline of technologies we were looking at. And every time we winnowed one out or it pruned up, we literally sat down for at least a half hour and said, what do we learn from that? And how do we do this process better for the next deal that comes along? And we had a success. We said, what do we learn from that? And I said, it's okay to make mistakes. It is and hopefully they aren't fatal, but it is unacceptable to repeat your mistakes. And it's unacceptable to repeat anyone else's mistakes. So, you know, you got to talk. And so that part of improvement is really important in any kind of company. And the reason it's especially important with startups is you just don't have the backstop. You don't have the safety net to not, if you start making the same mistakes over and over again, pretty soon you're going to be out of business. So
that's correct.
You need to anticipate things and not make those same ones again.
So John, let's talk about money. What's going on with money? What's the dynamics? Is it available? Is it more available for software or data companies? Is it less? I know valuation is one on top of mind. And then I want to hear from you, Nader, from the opposite side, because you're an entrepreneur actually in market. You get money. You're looking for working with VCs and angel investors. So John,
okay.
What's your time?
Well, it is right now, it's an inflection point. Things are starting to change as a result of all the change in the world around in terms of the pandemic and the economy at the end of a cycle and so forth. But in valuations, over the last 5 years, they had drifted up significantly from about averaging a $5 million pre-money up to about a $9 million pre-money. The concentration of deals kept moving up and up and up. And, you know, specifics in 2019, you know, only 15% of the deals were below 6 million, whereas in 2016, 61% were in that range. So the medians are moving up. The long-term sweet spot for angel investing are really deals that start out about $1 to $3 million. And that's where our big home runs come from. They don't come when you start at 15 or $20 million. And that's very important because of the nature of angel investing. It's definitely a home run business. Every angel portfolio I've ever seen analyzed, 90% of the return comes from 10% of the deals. So unless you can make those home runs really big, it's not going to cover the 60% or so that you see nothing back on. So we did a survey of the inflection point last spring, and 78% of our members expected valuations to diminish in the near future. Only 4% thought that they would rise, and 17% stay the same. 39% expected a 10 to 20% drop, and 29% expected more than a 20% drop. 11% actually more than a 30% drop. So it's important to be realistic about valuation at this point in time. Just saying somebody got a valuation 6 months or so ago doesn't mean that's the market price right now. As another reflection on that, Angel Capital Association has just done a survey on the pandemic and people's angels' attitudes as a result of the pandemic. And the survey itself actually is not going to be, you know, out there publicly until Tuesday, when it's going to be part of our annual fall forum. But I'll give you a couple numbers from that survey. 4% of the angel, we had, it was 117 groups participated across 40 states. So it's a pretty broad thing. Couple observations. On the valuations, 31% expected it would be down 1 to 15%, and 14% expected down more than 15%. So that's very significant. The survey also said that there are more deals closing outside of the group's geography. So it used to be if you go to an angel group and you're not in the right zip code, good luck, because they tend to just do local deals. There's a lot more being done more broadly because all the angels have shifted to these virtual forums. So they're realizing if they're doing the due diligence virtually and they're doing the screening virtually, we have some bandwidth and capacity to be able to see companies that are outside the geography. So don't feel that if you got a decline from the 1 or 2 angels in your area, it's some are still pretty parochial, but others are open to looking outside the geography. The member willingness to invest is shifting positive, but it's still negative right now at this point. It's not as bad as it was in 2002 and 3 or in 2008 and 9. But in April, we did a survey at ACA and 35% expected they would invest less and 2% expected they would invest more. So those things are pretty significant. The willingness to invest is, certainly part of it. But the good news at the end of the day is we still saw an increase, not over last year, because we had a record last year, 19 million, but it was still 30% higher than any other year that we've had. So the angels are still investing, and you get to that point in the cycle. So that's good. The thing is that it's what tends to drive this is when you get to this point in the cycle, usually the public markets are collapsing. And that's the currency that angels are using to make the investments in these companies. So when suddenly their market goes down 50%, which is what happened in the last 2 big cycles, everything looks twice as expensive and they feel twice as poor. And when they sell that stock that used to be higher, they just get stuck in and not wanting to do anything. And I think there's a lot of arguments to suggest that the public markets are going to come down sometime soon. PEs are at a ridiculous level now. The market PEs are like 24, which the only time it's ever been that high in the last 50 years was at the end of the dot-com area and in 2008. We all know what happened there. The Shiller PE, which factors in growth expectations, is at a level that's never been reached other than 1929 and 2001. We know what happened then. And the big tech stocks are all at very high multiples, 35 and up. The disruption in global trades is eventually going to catch up. The whole world is less productive because we're trading potentially less because of these trade wars. We're well past the longest expansion in the history of the country. COVID sort of, I think, stopped us from having a natural cycle down and got everyone really confused and not focused on the underlying opinions, but there were things happening in the last year prior to COVID that suggested that we were at the end of a cycle. The venture capital investments at a cyclical high, and that always sort of usually is followed by a crash. There are way too many unicorns out there that are not deserving of their valuations. Just as perspective, there are over 300 unicorns out there, companies that are valued more than $1 billion, but are still private. The combined total of them is over $300 billion of market cap. And just for comparison, in 2008, at the end of the last cycle, there were 8. And in 2001, there was 1. So this is an unprecedented level of greed and speculation that's going to ring out. Many of these companies are not profitable, cannot sustain themselves without a large infusion of additional capital. Some lack any long-term viable business model, such as a Lyft or Uber, which are, provide a great service, but they don't have a sustainable business model at their pricing, or a company like WeWork. In comparison, as the stock market crashes, many of these unicorns who went public in recent years or have not yet demonstrated consistent profitability will lose a lot of their value to people. And all these Icarus moments will suppress the appetite of investors to keep funding the new unicorns that are still private, and many of them will fail. So that's a big undercurrent. And then finally, there's obviously a lot of political uncertainty. And, I've never remembered a period, certainly in my lifetime, where you had one of the candidates saying, I may not step down if I lose this election. And who knows, all that uncertainty is eventually going to do it. So other than that, it's peaches and cream in the external environment. There is one positive thing that I'd like to mention from the angel world that's going to be a little bit of a bumper, and it's one of the reasons why we've sustained our investments in 2019, which is TCA now we have 3 major chapters, and each chapter has a sidecar investment fund. And this year, those funds are raised to be deployed the same year. So most years we've done between 11 and $16 million investment a year. Last year we did 19, but this year we have $6.5 million in the sidecar funds, which we're ready to deploy alongside the individual checks that we write. And that money's already been collected. It's all in the bank, doesn't have to get sold to be deployed. And all members have to do is say, yeah, I want to have that diversification, make that investment once things have gone through due diligence. So there's an underpinning that wasn't there in the previous cycles, where it was all kind of herd mentality and herd instincts. There's a stabilizing network in that funding environment. So
Thanks, John.
Anyway, that's a little bit in the background.
Thanks. Before Nader, before we go to you, I wanted to add a little more positive to your last positive.
Okay.
If you look at in July, the number of new companies that filed has gone from 20,000 average a month to about 40. So there is a lot of new companies being built. Now, they may be smaller companies, but there's this shift that people are somehow saying, let me get control over my life in some reason. There's another thing to consider. IBM, Apple, 3M, Microsoft, they all started in a downturn. And they all, we can see they're giants. One of the key things is that if you start in a downturn, or if you act as a startup in a downturn and focus on that value proposition, the thing that is absolutely needed, your success, because you are more focused than all those other people that have 17,000 things to deal with, and they're incumbents, and they have to deal with this and the people, and lots of overhead and lots of things to deal with that are addictional from past behaviors. So there is hope. And if you are focused, if you have something that is valuable to the customer, that is, it shouldn't be a deterrent. Number two is only about, everybody loves this money that comes from the venture capital and the angels. If you know the numbers better than I do, it's like 1 in 1,000 that are looking for money actually get, and out of those, 1 in 1,000 actually have a positive exit. So that's 1 in 1,000,000. So the chances are, if I want to bet on something, I'll bet on myself. I bet as the entrepreneur on building something. If there is value in what you're delivering, and as you know, in the venture capital, say if the dogs are eating the dog food, if actually somebody is buying what you have, then you have no problem people jumping on the deal. If you don't, then you would struggle. Yeah. So with that, tell me, how's it going in the field, Nader, now? What's your experience?
Well, Sid, I just want to build on that point a little bit. I agree totally with you. And at this point in the cycle is where often the best companies are born. And the reason for that is that to get the money, they had to work much harder to get it. They're much more frugal about how they spend their money. And they have much fewer competitors because nobody else got past into the stadium to play the game. So all those things kind of help companies in this cycle, and it ends up helping the entrepreneurs because a larger portion of those will be successful and they'll get the benefits, and it helps the investors. So I agree with your point. It's a great time. You have to get into a contrarian mode of saying, oh, the lights out, everything's terrible. That's when the Warren Buffetts of the world say, okay, now I get the checkbook out. So it's a good time, but you have to be pretty resilient and take a lot of no's.
That's right. That's right. And it is a good time, particularly, John, with respect to data analytics and data space, because there's lots more, appetite for it. People have passed these resistance lines. They're more ready to accept things. So you have a wave in this space with all AI stuff and machine learning stuff and deep learning stuff, all of that stuff is like on top of mind. People are making investments in those spaces. So there is a wave. The question is, and after I want to hear the dynamics of the money, I want to also focus on this idea of execution, because at the end of the day, it's all about where the rubber meets the road. Right? So go ahead, Nader.
Yeah, thank you so much. First of all, so one of the questions I ask entrepreneurs, what's the definition of CEO? And of course, 9.5 out of 10 says CEO is a chief executive officer. And I said, no, you're a rainmaker. And CEO to me is a cash extraction officer. You extract cash two ways. Number one, from customers, right? And by the way, getting money from customers is much easier and it will help you in a much longer way. And if you do a great job with customers, VC will follow. You don't have to go after them. They come knock at your door, right? And then the other way, you extract cash is, of course, from investors, right? So, and it is not easy, especially in this economy, it's not easy. Actually, what we hear and what we see in Silicon Valley is that most VCs are spending money on their existing portfolio, right? Remember, a lot of VCs, they invested in hospitality, in retail, and so on, which are not doing well. Those businesses are really struggling, right? So their number one goal is to protect their existing portfolio, right? So that's at least what we see, right? Now, let's talk about angels for a moment. So angels, again, they are individual angels, which they invest in you because they like what you're doing or they know you, or maybe they're your brother-in-law or whatnot. It's much easier to get money from those angels, or what I call angel syndicates, like exactly what John talked about, or band of angels, or sandhill angels, and so on. They're much more sophisticated. Now, one thing we also have to keep in mind is that a lot of the angels, they also look at the stock market. When the stock market is doing well and they have the cash, they're willing to take that money and they're willing to invest in your company. But when the stock market is not doing well, guess what? They're going to hang on to their money. So if I look at last year versus this year, Sid, I will definitely say the money is much tighter. Actually, in the case of recurring revenue, what we call SaaS, the benchmark that we all knew and loved was $1 million. If you have a recurring revenue of $1 million, VCs are willing to invest in your company. Now, that number, based on other feedback, it has gone up to $1.5 million, right? So I think the bar has gone higher. But you know what? At the end of the day, you as a startup, you have many options. And I want to talk about non-dilutive option. One of the ways we raise money was through government grants. For example, US government now, through Department of Homeland Security, Science and Technology, there is a group called AFWorks by Air Force, there is NSF, there is DOD, and so on. And you can actually get non-dilutive money from the government. What that means, it means you don't give them 10, 5, 20% of your company, right? And they really help you to get to the market and so on. So don't limit yourself to really only getting money from angels or VCs. There are other mechanisms to do that. And the last thing I want to touch on is what you and John talk about what's good and bad about the downturn. I started my first company during when the bubble busted in 2000. If you remember, I remember used to go companies and we used to present to customers. And at the end of the meeting, the customer would say, well, are you guys hiring? They wanted us to hire the customer. That's how bad the economy was. But in a bad economy, what you can do, exactly what you both talked about, is that you can become more frugal. The other one, you can hire some really good engineers and good marketeers for fraction of price, right? I mean, for those of us who live in Silicon Valley, hiring engineers was just, wow, average salary of $150,000 plus. Come on, that's a lot of money, right? But now I think those numbers are coming back to earth. So there are more people available and you can start a company much cheaper than you did maybe a year ago.
Yeah, I think just to build on the timing thing, I'll give you one more anecdote here. One of my diversions during this last 20 years was I was a co-founder and was in the spot of raising money as opposed to making investments. This was back in 2007. And the good news is we were successful at that. And we raised about $90 million over 2 rounds. But I was the guy managing all the spreadsheet of all those leads. And we got the first money from Kleiner Perkins, which was a great initial investor. And that it took 9 months of due diligence before they finally gave us our first $10 million. But we felt good because the first 8 months we did exactly what we said we were going to do, and we delivered exactly what we said we were going to do. And so we stepped up for the Series B in the beginning of October 2008. If you remember what happened in 2008, I remember being in a presentation with one of our potential investors, and he's looking at his BlackBerry the whole time and glancing down at the BlackBerry. And after this hour of presentation, he looks up from the BlackBerry, says, "I apologize. I haven't heard a word you've said. Since you started talking an hour ago, I've lost $3 billion and I don't feel like investing in anything now." And so what we thought was going to be a slam dunk, get another $60 million because we done all this other thing, it became a grueling process, and it took almost a year. But at the end of it, we were one of the few companies that had a Series B that was $70 million that year. But it was really hard to get that, and it took a lot of effort and resiliency to go through that. But I remember that spreadsheet I had. We ended up having about 9 investors in this company, and my spreadsheet, I forget how many lines, but it was probably 140, 130 lines. So we got 9 no's for every yes that we got, and that was even one that had gone through a successful raising. So you've got to definitely have thick skin. And in this point in the cycle, that ratio is going to be harder.
That's right.
But the people who do invest in you, they will understand just what we're talking about, that this is a great time, and
That's right.
it'll really help you be successful.
Yeah, and you reminded me, John, of 2008. I was in Europe. I was in France. Same time frame, probably the same hour. And all of a sudden I started getting all these calls and emails. What's going on? What's going on? I had 14 portfolio companies at that point, and I was on 6 boards. So you can imagine it was just complete mayhem. And what happened was that we had to let some things go because there was no follow on. We had to get a few of them, the ones that were absolutely focused. And I actually jumped into as the CEO of one of the companies because I love the company. And we had to say, forget about a dime. Nothing is coming. This is all about you and the customer. There is no investor. This is you and the customer. And it was rough times. But, out of the 14, 4 or 5 survived. The rest of them couldn't adjust to this because of the time frame and because of the time and the mindset. The mindset of execution. And the other thing that you guys have talked about the valuation you mentioned, there's a misnomer in a lot of early stage companies. Entrepreneurs, let me get a great valuation. Well, it depends who's investing. I mean, I always say, well, if this company is worth $1 million, but that, worth 10 million, but $1 million is coming in from Bill Gates, I'll cut the valuation. If it's coming from Sid, I'll maybe increase the valuation. It depends who's investing.
And high valuation may hurt you in the long run. Then the next
absolutely,
time nobody will invest
absolutely.
You. Sid,
there was one company, Nader, that I was investing in that I really liked the business. I thought it was a $3-4 million business. It was a good thing, and I'd looked at it, and the guy came in and says, "Well, we have a term sheet for $8 million pre." I said, "Well, this is not an $8 million pre-company." So went back and forth, and the guy said, "Well, our founder really liked this at $8 million. That's the number he had in mind." I said, "Okay, let me see." He says, "Oh, well, you could come in on this term sheet." I said, "Let me see the term sheet." I guarantee you there's something funky about it. And what it was, and this is because, the entrepreneurs who haven't done this focus on the valuation and not the details. It had a 5x liquidation preference.
Yes.
So they weren't really getting 8 million. They were getting somewhere around 2.5 million, which was less than I was willing to give them. But they were happy because the number. So the details matter. This is like everything else. It's not just the valuation that matters. It's all the other stuff that comes in. So let's go back to Nader, to you.
Yes, sir.
And Tell me about execution. You mentioned that you may be able to get better people. You have some, what's the COVID factor in all of this, and what
Sure,
are your thoughts?
sure. By the way, one last thing I wanted to say to entrepreneurs, and I learned this from one of my coaches, is like raising money, you have to go kiss many frogs to find that prince. So my message to the entrepreneurs is that don't give up. You folks talk about that out of 10, only one of them said yes. Well, sometimes out of 80, one may say yes. So don't give up. Just
Most of those
keep
frogs are not princes too.
That's right. You kiss many frogs and your lips are
There's a
sore.
lot of wicked witches that look like
But
frogs.
you don't find the frog. That's right. Exactly. But on the execution side, so very interesting. So so our company, Kiana Analytics, we have been focusing on what we call site management. What site management is that we look at the physical location like a building, and we can see the movement of the people. How many people are in conference room A versus conference room B? What's the capacity? And really the customers in this case are real estate and building owners. They are the one which say, do I need to buy more real estate? Do I need to add another conference room, and so on and so forth? So that's what we have been doing, and it's been very successful, 50 countries around the globe and so on. So in March, like everybody else, we learned about this term called COVID, and we learned about pandemic and so on. And I was reading an article on Harvard Business Review. I never forget it. This was like end of March, and there was an article, and the article was written by a lady, which is an human resources specialist. And she said, what do you do if somebody in your company has COVID? And the topic was mostly around, be passionate and go take care of this employee and so on and so forth. But then I learned the term contact tracing. And I don't know if you guys know, but contact tracing is actually a 100-year-old term. There was a gentleman, which actually, Sir Ross, actually got a Nobel Prize. He was actually a physician. He started the first algorithms and so on about contact tracing. And so when I saw this, I said, wow, we have all this data, right? And that's the beauty, I think, of big data and analytics, is that it's like a Rubik cube. You have the data. How can you turn it and look at the data from a different angle? And that's exactly what our company did, right? We said, wow, we have all this data. We can do two things for company. Number one, if somebody was tested positive for COVID using the Wi-Fi in the building, okay, no app, no new hardware, no new software, we already have all this data. Can I say who was she in contact with? So these people can go stay home for the next 14 days so they don't give it to their colleagues. So that was the first thing. The second thing you have to remember, unfortunately, about this virus is that it travels through the air. This virus is airborne. So, we all have learned about this. Hey, you're 6 feet apart, you're safe. Unfortunately, that's not the case. And actually, CDC just recently announced that. So if I'm in a conference room or in a classroom and there's no windows and I'm sitting 12 feet apart from someone, but there's air conditioning, the virus may go from one side of the room to the other side of the room. So we said, wow. So not only physical contact is important, but also location is important, right? What is it we have in our database, right? So we have time, location, and we have the devices. So based on that, we can, guess what? We can create a privacy preserving digital contact tracing solution. So in our case, SID was not really a pivot, it was an extension. So make a long story short, this has been very successful. We have been now helping a lot of universities and colleges outside of California. As you know, in California, most universities are all working on Zoom. They're all doing what I call Zoom University. But actually, if you look at Midwest, a lot of schools are open. Kids are in school. So again, how do you prevent the spread of this virus? So here's an example of the execution. But you have to really listen to the noise and signal out there and make a decision quick, right? You cannot drag your feet forever, and in our case, the execution was good. We had validation from customers and partners, and it was very successful. So that's how execution worked in our case there.
Excellent. John, before we wrap up, we're right about an hour. So tell us, across TCA or the boards that you sit on, what kind of execution challenges are you seeing because of COVID? What are people doing to act, react, and win in this environment?
Well, first of all, another positive about this particular inducement from COVID and the pandemic and stuff, unlike the previous two big downturns, there was a big effort that actually these young companies could participate in. That didn't happen in 2008, didn't happen in 2002. And this PPP really was a lifesaver for many of these companies, and it gave them at least a window to get their act together. It didn't solve the problems, but it gave them a window. And if we just did this survey, as I mentioned, ACA, and the answer came back, only 16% of all the companies that were covered in that didn't have PPP. And 46% had more than 50% coverage. So it was an immediate, and which you'll get forgiven. So it's like your non-dilutive funding. Suddenly, out of the sky comes all this money that's non-dilutive funding just when I need it to kind of keep the wheels on the car while I'm barreling along the highway. So that's important. The survey also said that headcount's down in 64% of the companies. Only 2% of the companies is actually up. The investment is down in most angel groups, but the ones that are surviving are the ones that took the actions very quickly. And there were a number of companies in my portfolio. You mentioned the 14 in your portfolio that last downturn. I had 2 or 3 companies, the one we were on the board on, that went under, and I don't think should have been if they'd had a different, entrepreneur who could have, done something about these things rather than just always assume there's somebody who's going to give me money in the future. But the ones that took action quickly, I would get in like 2 days after COVID started, I got 3 or 4. This is my game plan. I'm laying all these people off. I'm doing this. I'm cutting off on this product development. I'm saving all this, cut my burn rate from 160,000 to 35,000. I'm doing all this stuff, and we need help. And I started writing checks because that was exactly what I needed to hear. And the ones that said, "Oh, the world is not fair," and I so bad, they didn't get another penny from me. So it determines your access to capital. But really a focus needs to be on capital preservation and cash flow, trying to reach out to new customers to grow sales, but being very selective about that because a lot of new customers just don't want to do anything new. You're probably better off going at some of your existing customers, making sure that they're still in the tent and don't kind of leak out. The expense and staffing reductions, learning how to pivot. As Nader said, there's probably a silver lining somewhere in here for me. And I've seen a number of these companies. Some of them were obvious that that when it happened, it says this should help, and it did help. But other ones, it was not at all obvious, and it looked like it was the end of the world. And suddenly something happened that, like Nader was saying, that
it had a lot to do, John, I think, with the team, with how they executed, how they approached it, how they used the money that they had, how quickly they saw opportunities, and how flexible or coachable were they to listen and be collectively focused on, hey, this is life, and how do we make lemonades from this, these lemons.
Yeah, so it's, an example of one that just happened, with the company we'd been building for a long time, suddenly it was their day. And this was a company called GrandPad, which makes a tablet device for people over 75 to keep them connected with their families and their caregivers. And that's the iPads and the phones and all the stuff that we are comfortable using are not at all comfortable in that age demographic, and they're isolated. And so this was a company that was focused entirely on that problem. And, literally we have one person in the company that's 104 years old. So we understand the customer really well. We developed a very, very simple, passionate focus on this product. And suddenly when this happened, all sorts of folks in the healthcare space suddenly needed a way to talk to all the people who are now in homes and weren't going to be in hospitals, and they didn't want to go to nursing homes. And so suddenly that kind of took off. And then there are other ones, one that was in this data analytics space, who I've talked to you about it before. A company was originally called Emerald Logic. It's now called Liquid Bioscience. And they had come up with a neat technique to do data analytics, which was basically genetic algorithms. So they basically took a data set and they randomly created formulas to figure out which were the right factors. And they come up with 100 formulas. They take the 2 or 3 best, and then they genetically modify those formulas and then they take 100 and so in a space of a couple hours, they were coming up with predictions of things like, Alzheimer's, that it was taking 2 years and they were doing a better job than all the other data analytics because they had no preconceptions of what hypotheses were. They boiled the ocean and they could do it efficiently because they just had this cool way of doing it. Well, when COVID came along, everyone was trying to say, where's the next outbreak going to happen? So it's like Nader's story. So they said, well, we can do the same thing. We've got all this data on who's getting it where and geographies and all this. Just throw it in there and we'll start predicting where it's going to go up. And so suddenly, they were evaluated by the government and they were put at the top of the class as better than anyone else's techniques. And it wasn't like it was a company that was made for that, but they had a capability they saw could be applied and had nothing to do with what they'd been pursuing. So seeing opportunities where you can do that. You don't want to be so distracted to say, oh, well, gee, people need, they need to have, breathing mechanisms. So, and we don't do that. We're a software company. Let's go make a building that does that. That's not good. But if you're making something that's close or you have a capability that can be turned to it, that's really, it's a great time to do that.
That's right. So before we open it up to questions, if we have any, I think one of the things that we've all been talking about is the speed of execution, the fact that the world changes, crisis may come, and it's how do you roll with the punches, essentially. It's not just focusing, it's focusing on the right thing at the right time, and being able to essentially apply resources while your expectations and the realities that are changing should be in line, as opposed to sticking to here's my way or the highway. It's let's find the next path to success. So with that, gentlemen, I'm truly honored to have you guys join me. Thank you so very much, and I want to thank DataCon LA also to have given us the opportunity. So I'm not sure how this would work with our moderators and hosts, if there are questions.
Yes, there are a few questions. They're located next to the session. It's the session Q&A. Can you see it?
I do not see it, no.
Neither do I.
Oh,
I
you
don't-
can't see.
Is that in the Zoom interface? Because that's where I am.
It's in WOVA app.
Okay, no, I'm not in that now.
Can you
Okay,
can you
it's
help
fine.
us?
I
Why don't
can
you read them?
ask.
Can you read it?
One of
You
them.
know,
Can you specify?
we're older.
Yeah, he's
It's
right
okay.
here.
I'll help. This is why I'm here. I'll help. Don't worry.
Thank you.
Okay, go
Okay.
ahead.
The first one, can you specify what is PPP?
Oh, okay.
Payroll Protection Plan
Okay.
stands for, but that's the program where the government in the early stages, when the first round of funding came, that you could get enough funds basically to pay your payroll for a couple of months. And if you then kept those people on the payroll, the loan was forgiven after another period of months. So it's essentially a way to keep your payroll going.
Interesting. And the second question is, what do you see different during COVID pandemic differently from prior downturns? What do you see or expect changes in the future downturns or future pandemic? And what is your advice for future entrepreneurs? Probably we should ask one thing at a time.
So let me try to give you my 2 cents about what I see. This is what is different. This is fundamentally an induced process. That is, it's an artificially induced economic downturn. There weren't fundamental problems in the economy like the 2008, that there were all these loans that were going bad, and so the fundamentals were not wrong. This was induced and everybody had to go down. So that's a big difference. The big difference is that it's not that we have to solve a fundamental problem, foundational problem. It's not that the house has, a foundation problem. We've got to bring different kind of people to fix it. So that's the fundamental problem. The second thing is that I see, and these gentlemen may see it differently, I see the next 5 to 10 years would be an amazing time for technology. Just amazing. It is, everything has been unleashed. People that I mentioned, these resistance lines, I actually did an article in Forbes about this, that these lines people are getting used to. Those people that 70, 80, or 104 are using their tablets. And as they're using those things, they say, hey, I can actually order something. So they order something. So all of those doors would, it's not just a matter of retail. Everybody goes to retail. It's all of the back end stuff, all of those technologies that have to process these things. That's companies that would do that, storage companies, analytics companies that analyze the data. All of those are kind of side effects of this particular enhancement or fast forwarding of 3 months, kind of getting us 6, 7, 8, 9, 10 years ahead. So I don't know if you guys disagree or
Sid,
agree.
it's digitalization. I think really what COVID did, we all have been talking about this term called digitalization, which is really hard to pronounce, but really what COVID did, exactly what you said, it accelerated, right? I mean, I know daycare providers which are providing daycare through Zoom. This is something that most people didn't know what Zoom was maybe a year ago, right? I mean, that's really what's happening. Now, one thing I want to add for the entrepreneurs on this webinar today is that you also need to be flexible. Remember, your customers are also being impacted by COVID. We work with a company which runs a series of buses, and they said, you know what, our business, if we can make 50% of what we made last year, we'll be very happy, right? So you have to adjust your pricing, you have to adjust your terms to meet your customers' current environment, right? So instead of asking for yearly contract, maybe you ask for quarterly contract, right? But try to help your customers and try to stay on the game. I think that's really the key here.
I think what creates these innovations are a couple of different broad things, and then you got to think of what the specifics fit it. First of all, you get people who see an opportunity and do something, and then other people say, why don't I go do that in another space? So for instance, you started with the sharing economy, and somebody says, well, I can do it in sharing an apartment, I can do it in sharing a card ride, I can do it in renting my clothes out. So people were going from one business to the next, that we all own all this stuff, and saying, do we really need to own all this stuff that we utilize? But it's taking a concept across. So when you have a destabilization, there are going to be people who are going to find things like that. And then you can figure out what are the things that are like that elsewhere, and you can compress that. And I think over time, those extension kinds of innovations are happening in a shorter period of time than they used to take. The second thing is that's different about COVID, the pandemic-based recession, and the other ones, in addition to what you both have said and Sid talked about. It was less having to do with some broken rot in the overall environment, is that there suddenly are opportunities that didn't exist before, and it's changing so rapidly that there are second order things that happen. So for instance, the first order thing that happened was people have now shifted and saying, well, it's maybe not so bad, even if the pandemic's over, I'm going to have people working at home because I can save on a lot of office space and they're happier and this and that. And so I've got a new thing. So then there's the derivatives, all the businesses that thrive on that, whether it's the construction phase, it's home delivery of food, it's all the things that happen. Like, if you go now, if you look at the hot businesses now, first it was trampolines, because people got kids home all summer, they didn't know what to do. So trampolines were totally sold out. And now work at home desks, that's hard to get one of those. I live in Northern California like you, with all these fires. And so suddenly generators are a big business. And I mean, all these but look not just for the first order, but look for the second order, that when things change, what are the things that would enable? If you tried to say, I'm going to build a great line of home desk products for people working at home, and it was before the pandemic, you would have a long slog to do that because people weren't working home. Now they're working home. What are the things that I can deliver to people in their homes that I couldn't do before, and how can I help solve problems? So there's so much disruption that there are places where people can hang ideas onto that I think there will be more innovation in the next 10 years, just because we've taken 10 years of change forward. You know, people on climate change, we're all talking about, we're going to have a problem in 2050. Well, now people are having a problem. We're burning 5 million acres of trees in California out of 30. You know, suddenly we said, this is a problem we need to fix now, not in the future. So let's kind of accelerate those things and move them forward. And so people are seeing connections. So I was struggling to get a generator from my home because I had 3 blackouts in 3 weeks, and I was tired of having everything in the refrigerator go bad from all this stuff, and I couldn't get a generator. So I did some searching, and lo and behold, I found there was a product already out there called a power inverter. That's a little thing I put onto the battery in my car, and I plug it into, and I can run my refrigerator off my car and put the Honda Odyssey in the driveway. And for $200, I've got this quick little portable generator. Well, it's finding those kinds of opportunities that never would have, you know, happened. And if I happen to be the guy making a generator or inverters, I never would have thought any of that was going to happen. But when it happens, it's good. But from coming up with solutions, see where those things are changing and what things will ultimately be created as a result of those changes. And that's sort of skating where the puck is. You know, everyone talks about skating to where the puck is. This is kind of a new hockey rink relative to the previous downturns, that suddenly there are 10 or 50 other pucks thrown out onto the ice rink at the same time.
Right.
There are a lot of pucks to skate towards. You know, go get one of them, but you're not just confined to the one puck that was bouncing around. You've got a lot of potential targets.
And the fact that this has been accelerated in such a way, it means that the side effects or the ripple effects are now such big things that there's, as John said, not 10 or 15, but lots and lots of opportunities that not everybody has had time to capture because it's gone so fast. So there's plenty of opportunities for people to look at. It's, again, I go back to this idea of execution is key. Figuring out the exchange is key. And it's not just, hey, I have an idea, therefore I am an entrepreneur. You're not an entrepreneur unless you've figured out this exchange idea of, if you get something, you take a risk, you give it to somebody who's willing to pay you something. Can we go to the next question? I think we have about 5-10 minutes.
Yes. The next question is, if you would start a startup today, in which industry would you solve problems? Where is the money?
I would do it in something that has to do with data and analytics. That goes across industries, but I would start with one industry that has the biggest pain.
Yeah,
So,
there's an
Go,
old
John.
saying that, you know, rising tide raises all boats, but there's a flip side of that, which is a lowering tide, everybody's stuck in the mud. So if you happen to be a segment that's stuck in the mud, that's not a good place to be. And I tell you a brief anecdote. One of the companies we were trying to start out of Raytheon was company was called, it was optical phased arrays. And the problem they were trying to solve is to connect all the fiber optics. This is 2002. And the big companies were putting all this fiber optics underground, but they needed to connect it all up. And the solution that the technology that was being pushed was optical MEMS, which these tiny little mirrors that would point the light and bounce it around. And the VC industry had put $2+ billion into 40-some companies, and nobody could get this technology to work. And we had this technology that electronically steered the beams without any mirrors. We were using in defense. We were, you know, it was already deployed. We had 40 patents on it. It was like, you know, this solved the problem. Everyone who was there and all the existing problems weren't working. So we went to all the companies that had funded these optical MEMS companies, the VCs, and we said, look what you have. And every single one of them said, this is the most exciting thing I've seen ever in my space. Where were you 3 years ago when we were writing checks? We're just not writing checks now. I'm sorry. You know, I don't care how good it is. We're not going to write checks. Nortel's going bankrupt. Lucent's going bankrupt. Everything is terrible. You know, we're just not putting anything in space. We said, but at some point they're going to need to connect all this stuff together, and the stuff that you have isn't going to work. Those sick puppies in your portfolio aren't going to do it. And this thing actually has big barriers around it. You won't find 40 companies doing this because we got all these patents. And we convinced one VC to write a term sheet for $5 million. We needed 10. But it was conditional on finding another VC to write the second check. Well, it was the Sol Constellation. It was, I think, the only term sheet written in that space in 2002. And we never got the thing off the ground because it was a bad market. The other thing on picking, I think picking a good spot like data analytics is a good place, but it also needs to be a place that you are knowledgeable of and you understand the situation. Absolutely. And you have passion. And most of the good ideas out there comes from some entrepreneur who's felt a personal pain point themselves. And they say, if I fix this, maybe there's somebody else like this. So don't go off running into some space you have know nothing about, because you're most likely going to be disappointed.
Sid, can I give some ideas here? So one
Please.
area which we all eventually need to go back, some of us need to go back to work, right? We cannot continue working out of our bedrooms, right? If you are in a nursing school, if you're working some kind of a mechanical lab, bio lab, eventually you need to go back to work. So in the past, we were talking about smart buildings, and a smart building was a building which had solar panels, LED lights, and so on. Now the term smart building is changing, is also becoming healthy and safe building, right? Being able to detect viruses and where they are and where people are clustering and make sure we keep the social and physical distance and so on. I think, you know, we're talking about this pandemic, but there are going to be other pandemics down the road. And I think we as a society have learned and learning how to deal with this. So I think the working on anything quote unquote smart building will be a very interesting new wave in the next few
So
years.
let me as opposed to say where I would caution people, unless you know something really deep around the healthcare. Everybody says healthcare is great. There's lots of money, there's lots of activities, but everybody and their mother is trying to compete there with all sorts of different things. It is a confused space, and it's what they call dogfight in the old days in World War II. That all these planes are shooting. It's everybody is shooting at each other. So unless you have something extremely exciting and you have contacts in that business, I would stay away from it. That doesn't mean you have to.
There's two other questions.
I think we have time for one. So pick the one that you like.
Okay, there's, can you provide any books, videos, or website recommendations to study the market to spot emerging trends, possible solutions, or potential opportunities?
Ooh, John, that's your academic space.
I get my sources of insight from so many different places rather than reading a single book. It tend not to be in books because of even with the revolution in publishing, the ideas in books tend to be often stale by the time we get them. So I'm just an avid reader of a bunch of periodicals and magazines. There are about 30 that I read. And out of that, I find inspiration. And some of them are based on trends and innovations and stuff, but some are just sort of what's happening in the world. And just as you talked about, Nader, I think your point about the workspace is a great place. And if you get that planted in your head as an idea, then you say, okay, well, what are all the ways that I can improve that work environment? And what of them have something to do with something that I have here or that I could develop or come up with a solution? So I think you just read from multiple sources and get multiple ideas is kind of where I get my inspiration.
Yeah, I actually am very similar. I read quite a bit. I read about 2-3 hours a day, and I read different stuff from different industries, from different articles, and I believe that is how you get into innovative new ideas, because if you take it from one place that has already been developed and so forth. The other thing that I like to say is I would stay away for innovation and business perspectives to go to how-to books. After you're in, it's okay to say, how do I start a company, go over here? How do I balance my books? Okay, all of those things are how-tos, but you cannot learn how to be an entrepreneur from a book, because you have to be original. You have to have your own ideas. You're very different than anybody else out there. And maybe, I don't know, in a few months, my book would come out. It's called The Entrepreneur Philosophy. That I'll talk about that I believe it's your own philosophy that matters. I'm not saying don't read how-to books on mechanical things. There is learning in how do I sell, how do I do this, how do I balance A/B accounts, and all of those are valuable, but they're not making you an entrepreneur. They're just making you mechanically competent on doing one task. Entrepreneurship is not a series of connected tasks. It's a holistic effort. It starts with mindset. So,
Sid, if I may add,
ahead.
I agree with you. There's not one single book. The one that I read is Harvard Business Review all the time. And most of the time when I read some of those articles, I have no idea what they're talking about. It's way over my pay grade. But what's interesting for me is two things. This is what C-level, by the way, C-level, again, is the CFO, the CEO, whoever are reading, right? And then, so it's really important because it talks about the problems, right? The second one is that learn the lingo, right? What are people talking about? What are the buzzwords? And this is really important, really gives you a whole different perspective. That's the one I found to be very insightful. As I mentioned, we started this whole initiative at Kiana because of the article in Harvard Business Review. So it was very valuable to us.
That's awesome. Do we have time for one more question?
We have 3 minutes.
Okay. What do you see the appetite of investment in AI technology post-COVID?
You want to go first, John?
That's John's, yes.
Well, I think, AI is sort of in many ways related to data analytics.
Yeah.
And I think it is definitely one that's going to be a rising tide. But again, it's not the technology, it's what you can do with AI. And I think we're at the early stages of really figuring out what you can do with AI. And the other part is AI is not something like, well, I've just invented, an electric car, so now I know what electric car is. AI has multiple levels, and the best AI that's out there is really actually incredibly dumb, but there's levels beyond that where they actually start thinking as opposed to just doing things very rapidly that take us longer to do. And so as we go through those, there's going to be further enhancements, and with those and further enhancements will things go up. But it's thinking intelligently about where can AI really be used to really solve a problem. And those things will be very powerful businesses.
I completely agree. AI will be a big buzzword that people would like to be a part of it, including investors have a feeling to be a part of the new thing as well. But it's not AI that would get them the money. It's what they do with it, and that exchange and the value proposition and their ability to be able to focus, their ability to be coachable, their ability to realize that it's not the technology, it's the value proposition that actually attracts investors.
And the name is often abused because it's sort of like during the .com world, people said, all I have to do is put a .com at the end of my name, and I suddenly have a hit. Well, it's more than that.
The doors would open easier. Let's put it this way.
Yeah. I mean, I'm sure there's some people who just have a simple voicemail prompt system and saying it artificially and, takes you to the next step in the tree. And I'm sorry, that isn't AI. AI is when you call up and just say, hi, my name is Sid and I have a problem. And it says, yeah, and I know what your problem is.
Exactly.
Yeah, that's really cool.
Okay.
Well, thank you, Sid, John, and Nader for your presentation, and I appreciate all the attendees for questions and interactions during the session. Please contact the speaker if you have any further questions regarding this topic. Please provide your comments and feedback to us or the organizers on the community board, or start a discussion there to connect with others in the DataCon LA 2020 community. Thank you for joining today's presentation, and I hope you can gain some insights for this session. Have a wonderful day. Have a good weekend and be safe and be healthy. Thank you so much.
Thank you so much.
Thank you.
Bye-bye.
Thank you, everybody.
Bye-bye.